The people who manage the largest pools of money in the world are not on television right now. They are not posting on social media. They are not giving interviews. They are in quiet rooms, moving enormous sums in a single direction, and they have been doing it for 3 consecutive years without most investors noticing. What they are buying, and why they are buying it at prices that should have stopped them, is the most important story in finance right now. Something extraordinary is happening right now, and most people will not understand it until it is far too late. The numbers are in, the data has been confirmed, and what it reveals about gold and silver in this precise moment of history is unlike anything this generation of investors has ever been asked to process. This is not a drill. This is not a theory. This is a documented, verifiable, institutional rearrangement of global wealth. And the question you need to answer before you finish watching is a very simple one. Which side of that shift are you on? There are moments in financial history that only reveal their significance in hindsight. The decade before the collapse of Bretton Woods, the months preceding the great inflation of the 1970s, the quiet accumulation of gold that preceded every major monetary reset of the past century. We are, by every serious measure available, living through one of those moments right now. The difference this time is that the evidence is not hidden. It is sitting in the public record, published in central bank reports and World Gold Council disclosures, available to anyone willing to read it. The tragedy is that almost no one is. Before we go any further, consider this single, stunning fact. Central banks around the world purchased 863 tons of gold in 2025 alone. That number is nearly double the annual average from the decade that preceded it. And it follows 3 consecutive years in which sovereign institutions purchased more than 1,000 tons annually, a pace not witnessed since 1967. These are not ordinary investors chasing momentum. These are the stewards of national wealth, operating under multi-decade reserve mandates, moving with the deliberate purpose of institutions that understand what retail investors almost never do, that a structural change in the global monetary order does not announce itself with a headline. It announces itself with a tonnage figure on a central bank balance sheet. Now, before we go one sentence deeper into what this means for your savings and your future, if you have been watching this channel and have never pressed that subscribe button, this is the moment. We do not ask often, but what we are about to walk you through in this video represents months of research and analysis that most financial media will never touch. Press subscribe now, turn on the notification bell, and make sure you receive every analysis we publish. It costs you nothing. The knowledge we share here could change everything. Let us return to the evidence because the evidence demands to be taken seriously. The shift began in earnest in 2022. In that year, Russia's approximately $300 billion in foreign exchange reserves were frozen overnight as part of international sanctions. That single event did something no economist's paper had managed to do in decades. It made tangible, in the most visceral and undeniable way, the risk of holding wealth in paper assets stored abroad. Central bank governors around the world absorbed that lesson immediately. If a nation's dollar-denominated reserves could be rendered inaccessible by a political decision made in Washington, then those reserves were not reserves at all. They were hostages. Gold, held physically in a nation's own vaults, is not a hostage to anyone. It cannot be frozen. It cannot be sanctioned. It answers to no counterparty. And so began the most consequential sovereign reallocation of precious metal assets in more than half a century. Poland led this charge with a clarity that should be studied. The National Bank of Poland added 102 tons of gold to its reserves in 2025 alone, making it the largest sovereign buyer in the world for the 2nd consecutive year. Kazakhstan, Brazil, China, the roster of nations quietly building their physical gold positions reads like a geopolitical map of the countries most acutely aware that the dollar's reign as the world's unchallenged reserve currency is no longer the immovable certainty it once appeared to be. BRICS-aligned nations now hold 17.4% of global gold reserves, up from 11.2% just 7 years ago. That is not a coincidence. That is a strategy. And what of silver during the same period? Silver reached $54 an ounce in October 2025, then climbed further, breaking above $100 per ounce for the first time in recorded history in January 2026, ultimately touching $116 before a correction set in. Those who understood the underlying forces saw that move not as speculation, but as the natural consequence of an asset with a unique dual identity, part monetary metal, part industrial commodity, finding itself on the right side of 2 of the most powerful economic tides simultaneously. The energy transition is consuming silver at a rate mining simply cannot match. Every solar panel, every electric vehicle, every piece of AI infrastructure requires silver in quantities the market has not fully priced. and yet silver still sits, as of this July of 2026, at a level that Goldman Sachs believes represents the strategic commodity of the green energy transition. The correction did not break the thesis, it deepened it. What we are watching, if you step back far enough to see the whole canvas, is not a commodity rally. It is a reordering of how the world stores value, and it is happening with a speed and determination that ought to concentrate the mind of every serious investor watching this screen. Here is what almost nobody is talking about, and it may be the most consequential development in the global financial system in your lifetime. The Federal Reserve, the institution that has served as the primary anchor of global monetary confidence for generations, no longer tells the world where it is going. That is not an overstatement. It is a documented fact that changes everything about how you should think about gold and silver from this moment forward. On June 13th of this year, Federal Reserve Chair Kevin Warsh did something no American central banker had done since 2012. He withheld his personal rate projection from the quarterly dot plot, the forecasting tool that markets have relied upon for 14 years to read the Fed's future intentions. In a single act, the most powerful economic institution in the world told investors, in effect, that the roadmap no longer exists. The Fed will not tell you where it is going. It will not telegraph its next move. It will not offer the forward guidance that allowed investors to position themselves in advance of every major monetary shift of the past decade and a half. Warsh stated plainly during his confirmation hearings, he does not believe in forward guidance tied to economic data. And on his first meeting as chair, he proved he meant it. This development sits on top of an already extraordinarily complex backdrop. U.S. federal debt has surpassed $37 trillion. Annual interest payments on that debt exceed $1 trillion, a figure that would have been considered apocalyptically large a generation ago and is now simply a line item in a budget document that Washington treats with the casual disinterest of a government that has decided to stop asking hard questions. Inflation remains above the Fed's stated target. The jobs market has sent conflicting signals, and the new Federal Reserve Chairman has made clear that he considers price stability his primary mandate, raising the genuine possibility of rate increases at a moment when the global economy can barely absorb the rate levels that already exist. Now, and I ask you to take 30 seconds before we continue, drop a comment below telling us where you are watching from today. Every city, every country, every corner of this planet that this community reaches makes us stronger and makes us more committed to the work of bringing you this analysis. We read every comment. We build every video around the questions and concerns you share. Tell us where you are, and tell us whether this information is changing the way you think about what you hold, and why. Now, back to the machinery beneath the market, because this is where the argument becomes undeniable. The concept of the real interest rate is the engine driving everything you need to understand here. A real interest rate is the official rate minus the rate of inflation. When that number turns negative, when inflation rises faster than the interest rate the Fed maintains, cash sitting in a savings account quietly loses purchasing power every single day, even though the balance on the screen does not change. This is not a theory, this is arithmetic. And historically, negative real interest rates have been among the most reliable and consistent forces behind major rallies in precious metals. Investors do not need a philosophy of monetary economics to understand why. When cash reliably loses value, the rational human response is to find something that does not. Gold and silver have served that function for 5,000 years of recorded human commerce, not because they are romantic or traditional, but because they cannot be printed. Analysts who study these cycles closely point to an extraordinary current condition. The gold-to-silver ratio, the number of ounces of silver required to purchase a single ounce of gold, sits in a range that historically has preceded periods of significant silver outperformance relative to gold. This is not a minor observation. Silver, precisely because of its dual identity as both a monetary and an industrial metal, carries an explosive potential that pure monetary metals lack. When the safe haven bid aligns with a structural supply deficit driven by renewable energy demand, the resulting price pressure is not additive, it is multiplicative. Goldman Sachs maintains annual average targets of between $85 and $100 per ounce for silver in 2026. JP Morgan's Global Research Division anticipates gold reaching $5,000 per ounce by the fourth quarter of this year, and has indicated that $6,000 per ounce is a realistic possibility for 2027. State Street Global Advisors assigns a 30% probability to the $5,000 mark being touched this year alone. These are not fringe predictions from precious metals newsletters. These are the carefully considered public positions of institutions that manage more capital than the economies of most nations. The US dollar index tells its own story. The dollar has seen its share of global foreign exchange reserves decline consistently for 2 decades, according to IMF data. When the mechanism by which a currency's value is validated, the confidence and preference of foreign central banks, begins a structural erosion, the process rarely reverses quickly. It is the nature of institutional trust to break slowly, and then, at some unexpected moment, very quickly indeed. The British pound was the world's reserve currency for a century. Its transition to secondary status took decades to fully materialize, but it came. History does not grant exceptions. It merely changes the dates. We are at an inflection point. The Fed without a roadmap. Debt that exceeds the comprehension of ordinary human intuition. Central banks buying physical gold through price corrections rather than retreating from them. Silver at the intersection of the monetary and the industrial, facing supply deficits that analysts describe as among the deepest in the metal's modern trading history. The forces are not merely aligned, they are converging. The hardest thing in finance is not finding the right answer. The hardest thing is acting on it before the answer becomes obvious to everyone. When an opportunity becomes obvious, it has already been priced. When a risk becomes obvious, it has already caused the damage. The investors who built and protected real generational wealth throughout the monetary disruptions of the past century were not the ones who waited for certainty. They were the ones who learned to read the quiet signals, while the crowd was still reading the comfortable ones. Consider the historical pattern with the sobriety it deserves. In the early years of this century, gold was trading at a few $100s an ounce. It was an afterthought. Technology stocks were the conversation. Equities were the consensus. Gold was for the nervous and the eccentric. Then the technology bubble collapsed, and in the decade that followed, gold moved from below $300 per ounce to nearly $1,900. Silver moved from below $5 to nearly $50. The ratio of those gains dwarfed virtually every other major asset class across that same period. Those who acted early did not do so because they had a crystal ball. They did so because they were paying attention to the same kinds of structural signals, institutional behavior, currency fundamentals, monetary policy pressures that are present and legible right now, today, in July of 2026, for anyone willing to look at the data with clear eyes. The current situation carries unique characteristics that make the historical parallel both apt and, in certain respects, more urgent. What is happening with global stock market concentration should give any student of financial history pause. A small number of companies, primarily technology firms, now represent a larger share of total global market value than the combined stock markets of several major economies. Analysts who study long-term valuation cycles observe that this kind of concentration has preceded every major market correction in modern history. The argument is not that technology is without value. The argument is that when valuation stretches this far beyond any historical norm, the mechanism of correction does not ask for permission. It simply arrives. Meanwhile, the supply side of the silver market has developed a structural condition that deserves far more attention than it receives. The spread between silver's current market price and the average all-in sustaining cost of silver mining is, by some analyses, the widest in recorded history. This is not a detail. This is a fundamental market signal. When the cost of producing a commodity exceeds or approaches its market price, production contracts and future supply suffers. When industrial demand simultaneously accelerates, driven by solar photovoltaic manufacturing, electric vehicle production, and the extraordinary silver requirements of AI infrastructure, the resulting supply deficit is not a temporary imbalance. It is a structural condition that resolves in one direction only. We are watching, in real time, the most carefully documented and yet most broadly ignored wealth transfer setup of this generation. The central banks that have been accumulating gold through the price correction of early 2026, buying 244 tons in the first quarter alone, even as retail and ETF investors were selling, are not making a short-term trade. They are making a multi-decade statement about the future of the monetary architecture. They bought through a 25% price correction without reducing their pace. That is not momentum investing. That is structural conviction on a sovereign scale. The question every person watching this video must sit with is not whether these forces are real. The evidence documented in this analysis makes clear that they are. The question is a far more personal one. It is the question that financial history has put to every generation that lived through a genuine monetary transition. Will you understand what is happening in time to respond thoughtfully, or will you understand it after the most significant moves have already been made? This is not a call to panic. Panic is never an investment strategy, and the investor who acts from fear rather than understanding almost always arrives at the wrong destination, regardless of the quality of the information available. What history asks of us is not emotion, it is attention. It is the discipline to look at what institutions are doing rather than what headlines are saying. It is the patience to understand that the kind of structural shift described in this analysis does not resolve in a week or a month. It resolves over months and years, which means the investor who grasps it now is positioned meaningfully ahead of the investor who grasps it next year. Gold and silver are not exciting stories. They are boring, ancient, reliable forms of stored value that have outlasted every paper currency system ever devised by human ingenuity. Their virtue is precisely their monotony. They do not innovate. They do not disrupt. They simply endure. And in a moment when the Federal Reserve has abandoned its rate roadmap, when sovereign debt has climbed to levels that admit of no comfortable resolution, when the institutions that manage the world's largest pools of capital are quietly and relentlessly converting paper claims into physical metal, the enduring quality of gold and silver is not a limitation. It is the entire point. Watch the institutional behavior, read the central bank data, understand the real interest rate environment. Follow the US dollar index with the seriousness it deserves, and ask yourself, with the honesty that genuine financial self-interest demands, whether the assets you currently hold reflect an understanding of the moment we are in, or whether they reflect the comfortable assumptions of a moment that has already passed. The evidence has been laid before you, carefully, across this analysis. What comes next depends entirely on what you choose to do with it. And remember, this is for education and discussion only, not personal financial advice. I'm sharing a way to think through the history, the market, and the ownership questions so you can make your own decisions with your own money and your own risk. Finance Focus, built for people who take their financial future seriously.